my juice down in the club. I always keep that shit on top.
Good evening, everyone. Nice to meet you all once again. It's a little bit challenging organizing an event at this scale and still having the time to actually sit on a panel, right? So this panel, we're basically going to be exploring, what global investors are practically looking for or find interest in African markets. The African market is quite an interesting one, even as Africans, ranging from Afrobeat to the food to the culture, and now we're discussing about startup investments, right? I think we should first start with a couple of introductions. So, Darren, would you like to introduce yourself? And what do you do?
Hello, my name is Darren. I work with an organization called Endeavor. It is a global community of high-impact entrepreneurs.
Hi, everyone. First of all, thank you, Olumide, for having me here. My name is Tosin Dada. I am a partner at Brega. We are a European-based fund. We invest anywhere from pre-seed to Series C, and we recently launched a $75 million Africa-focused fund for early-stage companies.
Thank you very much.
Hi, I'm Oyin. I am a managing director at Techstars. Techstars is the most active pre-seed investor in the world. Specifically, we run accelerators, which means we invest in startups as well as providing them with access to curated programming and a global network of mentors and investors to help them succeed. And I run our activity in Africa.
Thank you very much. Ramez.
Hello, everyone. I'm very excited actually to be in Lagos and Nigeria for the first time ever. So it has been amazing, and hopefully it will be one of the many visits to come. And thank you again for the invitation, and it's very exciting to be here with you today. My name is Ramez. I come from Cairo, Egypt. I head Flat Six Labs. We are actually the most active seed and pre-seed investor in the Middle East and North Africa. We started a very long time ago, 13 years ago. And since then, we have invested, I think, in close to 500 startups across the MENA region. And actually, half of these startups are based in Africa, just in two countries, in Egypt and Tunisia. But we're actually also in the process of launching a new fund that will help us expand to new markets in East and West Africa. Specifically, Nigeria will be one of the main hubs for us in West Africa. And very excited to meet Nigerian startups and making some investments here very soon.
Thank you very much. Drawing from that, Ramez, having run a successful VC firm in the Middle East and African region, what factors would you consider that are driving the surge of investor interest in the region?
So we are from the region. Unlike many investors who maybe saw the region as another extension for what they do or what they have done before. We started in Egypt 2011 in the most interesting time in the country, just after the Arab Spring and the Egyptian Revolution. And we saw that there was a wave of very early stage entrepreneurs and founders who have a lot of passion and talent, and there weren't that many investors investing in them, especially at the early stage. And it was a huge gap in the market that we had to address. So we started Flat Six Labs. We ran the accelerator model where we put these startups through cohorts, invested in them small amounts of money, and presented them to the larger community of investors to follow on and keep supporting them. But we also kept our relationship with these companies and grew Flat Six Labs itself to expand to other markets in the MENA region. So we expanded to Saudi Arabia, in Abu Dhabi, Tunisia, Bahrain, Jordan, and Lebanon. So in 7 markets across the MENA region with collective assets under management in our funds of around $100 million, where we invested all this money and where we actively invest all this money in seed and early stage startups. For us, it was always about looking at the next market where we can actually expand the Flat Six Labs model, and the rest of Africa made a lot of sense for us. We have always seen a disconnect between North and Sub-Saharan Africa, if you'd say, where I'm sure you guys don't really see that many investors coming from Egypt or Morocco or Tunisia or North Africa in general, coming to Nigeria and investing in Nigerian startups. However, actually the other way is true, where we see a lot of investors coming from Nigeria and Kenya and other markets in Africa looking at Egyptian startups. So we felt very jealous. Also we felt like there's a huge opportunity in the market here for many of our startups that are eyeing new markets that make a lot of sense because like there are so many similarities between the Egyptian market as a large market, for example, and the Nigeria market or the Kenyan market. So many of them started looking at these markets for expansion, and also that motivated us to look at these markets and expand to them, but also mainly for the talent available here and the amazing startups we see coming out of Nigeria and West and East Africa for sure. So that were mainly the main drivers. It's mainly the investors that invested in our startups coming here, and also the market dynamics itself, where it's one of the most or the fastest growing markets when it comes to venture capital globally, actually.
Thank you very much for that. I think I'll touch on Tosin now. With your extensive experience, supporting Nigerian and African entrepreneurs, what would you describe and how can you describe the evolving entrepreneurial landscape in Africa, at least in the past 4 years?
Yeah, thanks. I think even in the past 7, 8 years, when I think back just in terms of how the market and ecosystem has evolved, and Ramsey touched on it, how difficult it was to raise early stage capital 7, 8 years ago. And I think we're lucky today because the entrepreneurs before our time, so the older entrepreneurs, not older in age, by the way, I mean older in terms of their company. So companies like IntoSwitch, like Paga, like Jumia, they've done the hard work of proving that the opportunity is there. And because of that, entrepreneurs today can raise early stage capital. They can comfortably raise a pre-seed round with local angels, local HNIs, and local funds. That wasn't the case a few years ago. And if I think about why Africa is still important for investors today, why we're still bullish on Africa, a few things, but I'll focus on 3 things. One is our young population, which translates to young consumers and tech-savvy consumers. Number 2 is increased digital connectivity that we're already seeing across the continent and across different markets. And so in closing, I know that people say, oh, where we are today, there's regulation challenges, currency challenges, devaluation. But when I think about where we are coming from and where we're going and all the potential growth levers that we currently have, I think it's still the best time to invest in Africa.
Thank you very much. I think Oyin is for you now. Given your experience, leading the Techstars, expertise in early stage investing, particularly equally also the fintech space, could you elaborate within the fintech and other sectors, what currently attracts investors the most?
Hello? Okay.
Yeah.
Sure. Thank you for the question. So I think it's not as easy as kind of talking from a sector perspective anymore. I think a lot of the investors, including ourselves, who a couple of years would have taken a very hard stance from a sector perspective, has seen it's not as easy as that. So when we did our first program for the ARM Labs Lagos Techstars Accelerator, we said fintech, fintech, fintech. But then what we soon realized is that fintech is very much a cross-functional infrastructure, really. So the same way we consider technology, the same way we should be seeing AI, in my opinion, we see fintech in that it doesn't matter what sector the company is in, there probably is a fintech play, whether it's to do with payments or whether it's to do with wallets, whether it's to do with credit, there typically is a fintech play there. So it's certainly not from a sector perspective, although we are seeing a lot more money going into green at the moment. So I think what we're really looking for at the moment is it's back to business fundamentals. It's back to, let's take a look at the founder. is the founder likely to succeed? And what we're looking for is, does the founder perhaps have experience being a founder before? Because hopefully that means that they've learned from the past. Does the founder have deep domain expertise that means that they are well positioned to succeed in their sector? So do they have an execution bias, or are they just a visionary? Can they demonstrate that they can actually get stuff done? So we're looking at that. And then I think we're looking at the market potential, and we're looking at the unit economics, and that was discussed in the last panel. But we're looking at, is there actually a big, sizable market in what you are creating? Because unfortunately, the reality is that the African ecosystem and economies are relatively small and quite heterogeneous. It's actually really difficult to build a VC-backable business. And if we look at the likes of the Instagrams of the world and the WhatsApps of the world, they demonstrated what VC really is. It really is about putting money in a company that can scale really, really quickly. So these organizations were worth billions with employees of less than 50 people. Whereas, it's very difficult to get to that level of scale on an African continent. So we're looking at, can you build in a market that actually makes sense? Do the unit economics make sense? Can you acquire that customer cheaply enough versus how much money you're going to make from them in the long term? Are you able to cover those variable costs multiple times over with the revenue that you're able to produce from them? So it's really that, the business fundamentals and the quality of the founders.
Thank you very much. That's quite interesting, talking about the business fundamentals for any entrepreneur. Derry, with the organization you work for, with your focus to access to capital and entrepreneurial support network, can you dive into deeper specific funding mechanisms and deal structures in Africa? How do they differ from other established markets?
The specific funding mechanisms and deal structures. So I think fundamentally the funding mechanisms in Africa are not different from other markets. I'd say there isn't a difference in kind. There might be a difference in degree. So what I mean is venture in every market. Private equity is private equity in every market. Debt is debt in every market. And fundamentally they operate similarly. However, it's important to understand that the venture ecosystem in Africa is only, I'd say, around 15 years old. If you go back to, say, 2010, 2011, the level of venture in the entire continent was probably less than 100 million per year. Last year, it was about 3 billion, right? So venture has grown a lot in Africa, but it's still just a 15-year-old industry on the continent. What that means is there's a degree to which we need to mature, there's a degree to which we need to learn, but also most of the players in the industry haven't gone through a full cycle of venture capital. And so what I mean is the venture market typically goes through these cycles where, things are getting more and more optimistic, valuations are increasing, people are getting more excited, and then there's a correction where things come down. And so these corrections are a normal part of venture, but today, the African ecosystem is going through its first correction. And so if you've not been through one before, there's a chance that you become scared. You start to ask questions. You hear people saying things like, will venture work in Africa? Or where are the exits? Or, which business models should we fund? And things like that. But fundamentally, over time, as we become more and more experienced in the space and as we go through more cycles, we'll see that venture in Africa is the same as venture everywhere. I think the ways in which I believe that venture needs to evolve on the continent, first is I think we need to continue being more and more founder-friendly, which doesn't mean you don't hold the founder accountable. It just means you understand that entrepreneurs are the main drivers of success in venture. Second, I think we need to be more comfortable with failure. I think today we're seeing a lot of companies struggle. I think we're seeing companies that have raised capital fail. And it's shocking to us and as an ecosystem because it's like, oh, this company raised 20 million, 30 million. How can they fail? It's a ton of money. But if you understand that we're playing a game where you're funding very high-risk businesses, then failure is inherent in the model. So I think we need to be a lot more comfortable with failure. And then the final thing I will say is I think we need to be a bit more global in our mindset or in our perspective. I think we need to learn from other markets. We need to follow which business models work in other markets. We need to follow trends in other markets. We need to learn how to tell our story globally. And we also need to think about building businesses that are global in nature. So I'd say those are probably the ways I'd like to see the model evolve. But in terms of how is it structured, it's the same as it is in any other market.
Thank you very much. I think we should broaden the conversation a little bit. Tosin, given your experience working in terms of a social impact investor at some point, what are the evolving trends right now? And in this regard, what do you consider would be what the future is going to be like for social impact firms?
Okay. I think that's a setup question because if I mention a sector that is not someone's sector now, then they will tell me I don't like their sectors. So I will not fall into that trap.
Yeah.
But I'll speak generally on what we like and what we're seeing in the market. And Oyin touched on it, fintechs. There would always be a lot of fintech companies just by virtue of where the market is. Different types of fintech services from payments to lending. We're seeing a lot of lending. But the thing about lending, I always say, is it's very complex. And it can fall apart very quickly. And so if you're doing something in lending, for instance, it's important that you think of another value add. And so I really like embedded lending or embedded financing because there's something else that's making your consumers or your customers sticky. Something else that we're seeing is smart farming and precision agriculture. Now that's quite new and it's something that we are learning, but if it's able to scale, if it's able to take off, then it's something that we absolutely need. Because if our continent is growing the way it's growing, we need to feed these people and we need to think about how to get products from farm to table or from farm to stores or to supermarkets with with reduced shrinkage. And just lastly, another area that we're seeing a lot of businesses that's also somewhat new is EV. And seeing that a lot in Kenya, not so much Nigeria. I think Max is one of the players here in Nigeria. I think there are one or two other players, but I don't remember what they're called. But we're seeing a lot of EV companies in other markets, battery swapping companies in other markets as well. And I think it's something that eventually will trickle down to the markets, to the other markets in Africa. Not that we prefer those sectors, those are just different sectors that we're seeing from the regular health tech, edutech, fintech companies.
Thank you very much. I think right about time. Oyin, considering your work with Techstars, how can investors build successfully mutually beneficial relationships or collaborations with African startups?
I think Darren mentioned this earlier, right, about investors being a little bit more founder-friendly. And I think ultimately what I think are understanding more is that the relationship between investor and founder has to be symbiotic. It should be a win-win relationship. The founder succeeds, the investor succeeds, everyone is happy. But the only way that you really get to that level of relationship, I think, is with great communication and a lot of transparency. And I think for too long, a lot of founders have felt that them and the investor are on different sides of the table, or they have felt the need to perhaps hide when things go wrong, when really when things are going wrong, that is the time to engage your investor. That is the time to get them to do their work, which involves helping you strategize, helping you open doors, giving you tips as to how to increase your revenue and reduce your burn. That is exactly the time. But the challenge is a lot of founders don't keep their investors along the journey with them. And the best way to do that is simply by keeping them up to date with your investor updates, be it monthly or quarterly, just keeping them up to date. So I think if that relationship exists, then a great relationship can exist between the investor and the founder. Because ultimately, the other thing that, to Darren's point is, the nature of VC is that, the expectation is that a lot of the companies we invest in will fail. But a minority will turn over the portfolio. And we understand that. So because of that, founders should feel even more confident going to their investors saying, hey, times are bad. How can we turn it around so that we're one of your wins rather than one of your losses?
Thank you very much. I think one final question for everyone, starting from Ramez. What best practices would you recommend for global investors looking to expand or establish some sort of presence in the African market?
It's a good question. We always say, I think you have to do the fundamentals right. And I think during maybe what we call the COVID years, a lot of people actually forgot about these fundamentals, where we have seen so much fast money coming into the ecosystem, or what we call tourist investors coming, or maybe running their due diligence over Zoom. So I think going back to the fundamentals, where you have to do your due diligence about the market and about the startup you invest in very well. You need to have presence on the ground. I think just maybe linking back to one of the things that were said on the previous panel, I think VC, you always have this struggle where you can be very hands-off. You can be just like a bank writing a check, or someone passively writing a check to a founder, or you can be so much hands-on, competing with the founder on their own day-to-day and how to run the business, right? But you still need to add value at the end of the day. You have to have presence on the ground, especially if you are a global investor. If there are no value in you investing in this company and taking them to a new market, then you are not really adding much than the local investors, for example. If you are not adding value locally by building connections, say in Nigeria or any other market in Africa, and supporting the company with these kinds of connections or know-how or whatever, then also you're not adding value. So the value add is really important when it comes to venture capital. Otherwise, you're not really adding much to the company. The next startup won't really take money from you, and then you have to cover these fundamentals very well. And I think just going back to the fundamentals of the nature of the relationship of the investor and the founder, and maybe something like Tito said on the previous panel, it's very much like marriage, but you know that it will end in divorce. And everyone has to be cognizant of this fact, right? It's not a marriage forever. Actually, it is a successful marriage when it ends in divorce, where there's an exit. So I think just being aware of this fact all the time when you are making the investment, that you are actually making it for a period of time. It could be 5 years, 10 years, whatever. But you eventually really need to exit for you to actually make your money back, and for the founder to move on to the next investor or the person who can add value to them. So I think this is really important. Just covering the fundamentals, I think, is the basic we can ask for now.
Okay, thank you. Oyin?
Oh, wow. Ramez said a lot there. The only thing I would add is about international investors understanding that what success looks like in an African context may be different. So, for example, if we talk about exits, a lot of successful exits in US, Europe, it looks like IPO. But here, a successful exit might look like a secondary sale. It might look like the pre-seed investor selling to a Series A investor. Or it might look like a corporate sale, which we're seeing a lot more of. So I think understanding that may look different, understanding that therefore the return profile might look different. You might not be looking at a 10-year return in 7 years. Instead, maybe should be looking at a low return in 2-3 years because of that secondary sale or because of that corporate sale. And then kind of tagging on to what Ramez said about local presence. And it's so awesome that Brega and Flat 6 Labs have Africans overseeing the African portion of their investments. But in addition to us having Africans overseeing that investment, we also need them to do the work of opening doors for those founders. So the investors also need to be able to be equipped with that. They need to be equipped with the relationships to open that door, be it an investor, be it a corporate, be it a distributor, etc. It goes far beyond just capital. And actually, the third thing that I've just thought of off the back of that is about the fact that our founders need more than capital. And it is just the reality. As Darren said, it's a really early ecosystem, which means that we shouldn't be surprised if you give a few $1 million to a young person and they don't know how to spend it. Right? So we do need to understand that investing in the African context, especially if you're investing in a young person, often means that there needs to be a more hand-holding relationship in terms of ensuring that they are equipped to succeed.
Thank you. Tosin, do you want to touch a little more? Okay.
I can just quickly add, I think Oyin and Ramez have covered everything. I do agree that, yes, it's important that you have local presence and people that actually understand the market, working with the global or international investors. But I would also say that it's important to think about the way we evaluate companies here and companies internationally as well. You know, you have to be careful because you don't want to say that, for example, you know, Nigeria has 200 million people, and say, for example, I don't know, Spain plus Portugal and et cetera, they have 200 million people. So therefore, this company should be growing exactly the way the companies are growing in Europe. But GDP is different. Consumer purchasing power is different as well. So I think, yes, have people on ground, but actually do understand that they're completely different markets in terms of where they are in their journeys.
Thank you very much. Darren, do you want to have a go?
Yeah, I think the only thing I'll add is if you're a global investor looking at an emerging market, you need to stay for the long term, and you need to stay when things become difficult, because you make your money when you invest in difficult times. At Endeavor, we've made a large percentage of our returns from Turkey, from Argentina, from markets that, like Nigeria, have gone through currency crisis, political crisis, economic crisis, and because we've been in those markets for the long run, we've seen returns. And so if you're an international investor who pulls out every time there is some uncertainty, you're just not going to be successful in that market. And so that's the only advice I'd give to a global investor looking at an emerging market.
Thank you very much, all. The panel now comes to an end. And if you have any questions, feel free to meet them after the panel. We won't be taking questions for this panel session.